Hello everyone and welcome to the YouTube channel of BeingACCA. This is Tushita Gupta, ACCA affiliate, and in this video we are studying chapter number 18, Business Valuation. This is your FM revision series chapter wise. So we have reached towards the second last chapter of your FM syllabus. So the next chapter is only going to be a very small video because it's ratio analysis, and all of the ratios, the formulae we have studied in whatever we have studied so far. So it's more like a recap in that sense, and then the next video is going to be a recap of a recap, so it's going to be a smaller one. This one is regarding business valuation. There are a few things to remember over here, some new things regarding behavioral finance, so please make sure that you are paying the due attention to this chapter and practicing enough questions. Now, without any further ado, let's get started. So the first thing that we learn in the business valuation chapter is number one, like the name suggests, valuation. So why do we really need valuation? So why is valuation needed? So valuation may be needed for two. Now, what are the things you would need a valuation for? Number one, if you want to determine how valuable is a private company. So to determine the value of a private company. Also can be used to determine the maximum price that you're supposed to pay. Let's suppose I want to take over a company, I want to acquire it completely. So what value does the company have? How much should I pay to so that I am able to acquire that company? So number two is determine maximum price to pay when acquiring a listed company. And over here, it could be for a merger or a takeover. Another reason, another place where valuation will help you is to place a value on any company which is entering the stock market. Place value on company entering the stock market. So this basically means if any company wants to have an IPO, then you will also need the valuation to decide what price is the company going to offer the IPO at. And lastly, can be needed to value subsidiaries or any division if I want to sell them. So let's suppose I have a big company and I have a lot of divisions and subsidiaries with myself. If I want to sell any specific subsidiary or any specific division, how do I place a value on that? So valuation can help me with this also. For possible disposal. All right. So these are the reasons which, for which you will need valuation. These are the places where business valuation can help any company. Now, what is the information that you are going to be needing when you are placing a value on a company? So information requirements. Number one, you're going to need the financial statements of the company. Number two, you're also going to need the summary of their non-current assets. Summary of non-current assets. Then you'll also perhaps want to have a look at how much working capital the company is having. So number three over here will be a summary of working capital. Number four can be about budgets and forecasts. So if anything has been forecasted or has been budgeted by the company, what do these budgets and forecasts looks like? Budgets and forecasts. And then what else could you possibly need? You could also have a look at the summaries of contracts which they have, perhaps if they have taken anything on lease or, any sort of arrangement which they are already in. So if you're acquiring a company, that arrangement, do you want to continue that arrangement or do you want to stop that arrangement? So you should know what are the arrangements that the company has entered into. So summaries of contracts such as leases. Then what more information could you need? You can also, ask or, tell the people that we also want to see how much are your, shareholders, like who are the people who are your shareholders and how much holding do they have in your company. All right. So the next thing that you could ask is probably the details about the shareholders and how much holding do each of these shareholders hold, and their holdings. And what else could you perhaps ask more about? So it could also be information about industry and the wider economic environment. Industry and wider economic environment. So these are a few things which you will want. These are the information requirements that you will have if you want to place value on a company. Now, always remember that valuation is not something which is precise. Valuations are subjective. So valuation only gives you a range. It's a maximum and a minimum which the valuation gives you. The ultimate price at which companies are taken over, merged, acquired, all of this depends on negotiation. So basically, valuation gives you a starting point, and then ultimately both of the parties negotiate and then arrive at the final price. Now, when it comes to valuation methods, there are three valuation methods, three types through which you can value a company. Number one over here is asset-based valuation. Number two is income-based valuation. And number three is cash flow-based valuation. So these are the types of valuation methods. We'll first have a look at the asset-based valuation methods, within which we have multiple methods. So asset-based valuation. Now, number one over here is your net book value method, NBV. It's a simple formula that it gives you. Your equity is going to be equal to your assets minus liabilities. Now, over here, what are the problems which will be faced? Problems will be, number one, that your balance sheet values are actually based on historical costs. So it's more of history rather than representing what the present scenario is. So you can say based on historical costs. And then another problem with this method is that the values basically for your assets will depend on the depreciation and amortization policies which the business has used. So perhaps if we have chosen to implement the written down value, the value of the asset will be something different. If I chose the straight line method, then the value of the asset will be something different. So hence the values basically are influenced by the policies which the business has adopted. So values depend on depreciation or amortization policies. And then last but not the least, you have another problem that, there could be some significant assets which are not recorded in the balance sheet. For example, internally generated goodwill, according to the IFRSs, it's not allowed that, for a business to actually record internally generated goodwill in the books of their accounts. So significant assets may not be recorded for example, internally generated goodwill. Now, these are the problems with this method. Now, let us move towards the second method that is available under your asset-based valuation. So, the second method that we have is your NRV, net realizable value method. Over here, the value of your equity is going to be determined by the estimated net realizable value of your assets minus any liabilities. So, this is how you determine the the value of equity on the basis of the net realizable value of your assets. Now, over here also there are a few problems. One problem remains the same with regard to unrecorded assets, for example, internally generated goodwill. Another problem as far as this method is concerned is the fact that it is difficult to estimate the net realizable value of the assets for which there is no active market. Now, what do you mean by this point is that, there are a few assets which are very often like there's an active market. That means there's active buying and selling of that asset. But for example, the business has certain assets for which there is no active market, like the buying and selling of this thing has become very rare. So it will be difficult for you to determine that what will be the net realizable value for that sort of an asset. So you can write this as difficult to estimate NRV for assets for which there is no active market. Now let us move towards the third method, which is also available under your asset-based valuation. This method is called net replacement cost. So how much will it cost if I want to buy a business and I'm basing its value on how much it's going to cost to replace all of the assets that the business currently has. So the value of equity in this scenario is given as the estimated depreciated replacement cost of the assets. Cost of the assets. So this is how you work out the value over here. Now, this method also has its problems. One problem remains the same in all of them, that it ignores unrecorded assets. Same about the internally generated goodwill. And then the second problem over here being that, there is a probability that technological change has happened. And if something like that has happened, then it is difficult to estimate the comparable, to determine the value of comparable assets for the purpose of valuation. So technological change difficult to determine value of a comparable asset. Now with this, we are done with the asset-based valuation methods. Now let's move on to income-based valuation. Let me change the color of my pen over here just so that there's a sort of a, difference that you can see. All right. So here, let's talk about income-based valuation methods. All right. So over here, number one method that you have is your PE ratio. Simple, you use the PE ratio to value the company. Over here, the value of your company is nothing but the PE ratio multiplied by the earnings of the company. And what will be the earnings? You will take the profit after tax, subtract any preference dividend, and then you multiply this with the PE ratio to find out the value of the company. This is a pretty simple method. Now let's talk about earnings yield. This is the second method under your income-based valuation methods. Now earnings yield, the formula for earnings yield is given to you as EPS divided by the market price multiplied by 100. So over here, how can you find out your ordinary share price? Ordinary share price for the valuation purposes, it's going to be equal to EPS divided by your earnings yield. So this is how you use the earnings yield method to value a company. With this, we are done with the income-based valuation methods also. The third type of method, which I told you, is the cash flow-based method of valuation. So let us go towards that now. All right. So cash flow-based methods of valuation. So over here, you have two types of methods again. Number one, if you have a constant dividend growth, then your price is equal to dividend into 1 plus G divided by divided by RE minus G. So this is how you work out your price if you have a constant dividend growth. Now let's talk about another kind of method which is available under your cash flow based valuation methods. So under that, the second method which is available to you is a discounted cash flow basis method. Now over here, it's very simple. The value of equity that you have, value of equity, that is equal to your value of assets minus the value of your debt. This is the formula that you're supposed to use for your discounted cash flow basis. Now with this, we are finished with the valuation of equity. Now how will you value the debt? So debt valuation is what we study next. Now, under debt, there are different sources of finance, and you would want to know how to calculate the value of all of the different sources that we have under debt. So let us go one by one, source by source. All right. So let's first talk about preference shares. How do you value preference shares? It's going to be P0 is equals to D upon RE. These are the formulae which we have learned previously under cost of capital also. Secondly, if you want to calculate the value of irredeemable loan notes, then it's going to be P0 is equals to I upon RE. Over here, I stands for the interest which is paid on the loan notes. Thirdly, you have redeemable loan notes. So how do you calculate the value of redeemable loan notes? It's nothing but you calculate the present value. Present value of what? All of the interest payments that the investor is going to get plus the maturity value that the investor is going to get. You discount that at the investor's required rate of return. So it's nothing but an NPV, which is discounted at the required rate of return of the investors. And please make sure that when you're taking the interest payments, you do not deduct the tax, because it is not the investors who get any tax benefit. It is the company who gets a tax benefit. That is why we subtract the tax element from the interest. But over here, you will take the absolute interest. You will not subtract the tax that you are saving on that interest, because valuation is from the perspective of the investors. Hence, you will take the full value of interest and not subtract any tax from it. All right, let's move to the last source of debt that we have, that is convertible loan notes. How do you value your convertible loan notes? Nothing again but the NPV. Again, over here, you take your interest payments plus on the maturity, you take the higher of the redemption value or the forecast value of shares, forecast conversion. So whatever is the higher one, you're going to take that plus the interest discounted at the investor's required rate of return. This is how we have completed the valuation portion as far as debt and equity are concerned. Now, before we wind up this chapter, we are left with the last portion. This portion talks about what are the practical factors which will influence how a company is valued. So let us discuss the practical factors. Practical factors which affect business valuation. So number one thing over here is about the marketability and liquidity. Now, what do you mean by both of these terms? Marketability basically means, am I able to sell it on the stock market? So if any share is listed, it is said to be marketable. If a share is marketable, definitely it's going to be more valuable, because an investor can anytime go to the market and sell the share. And liquidity again means how frequent is the trading in that share. So let's suppose you have a very good share, but the liquidity is not there. You go to the market, but there are no buyers for that share. You want to sell your share, but there are no buyers standing in the market. So the liquidity is poor. Hence, this will affect the value of the share adversely. This is how marketability and liquidity affect business valuation when it comes to the practical real life. Other factors include information sources and their availability. In the very beginning of this chapter, we talked about the different sorts of information that we will be needing to value a company. So over here, this point talks about information sources and their availability. So whatever information you're getting, from which source are you getting it? Is it a reliable source? Is it not reliable? And availability, definitely, if you need some sort of information, but it is not available, then that is also something that will affect the valuation of the company. Then the third thing, if you talk about, is the market capitalization. Market capitalization is nothing but the number of shares that the company has in issue multiplied by the current market price. So the higher the market price, more valuable the company is. Lower the market cap, lesser valuable the company is. Then if you talk about one more thing, this is market imperfections and anomalies. So even though we are, in all of the models, we are assuming that we have a perfect capital market, but in real life, your capital markets are not perfect. They have imperfections and they have anomalies. So what are the imperfections? What are the anomalies? Let us try to understand some of them with the help of a few examples. So the first example that I would like to give you when it comes to market imperfections and anomalies is, number one, you will find irrational investor behavior. Now, what do I mean by this? Is that the investors who are there in the market, they are not always rational. What happens, let's suppose the price of a share is continuing to increase. So the investors are going to believe that this price rise will continue in the future also. So this is irrational investor behavior. It is not necessary that if today the price is rising, tomorrow, day after tomorrow, and for the time to come, the share price is only going to rise. This is not true. But this is how investors believe, and this causes imperfections in the market. Now let's talk about another example. This is called as the January effect. Now, what is the January effect? What do people do? Let's suppose we are currently at the end of December. The December is about to end. So what happens? People will sell off their shares to utilize any tax losses. Let's suppose I have made losses on any share. So I will sell that off so that I can book a loss, and then I can get some relief on my tax payments because I have booked that loss. And then once the year has ended, January has started, then I will buy back those shares again. So this action, which is done by a lot of people on the large scale, this causes imperfections in the market. This is what you call as the January effect. Let's also study about a few more effects. Number 3 over here is your overreaction effect. Now, what happens in the overreaction effect is that, let's suppose there's been a very good news about a company or a very bad news about a company. So what happens because of this effect is that whenever this news is in the market, the shareholders are going to overreact to this news. If there's a good news, the price will rise beyond any limits. If there's a bad news, the price will fall very badly. But ultimately, what will happen is, once the situation is normalized, the value of the share is going to go back to its fundamental value, to its actual value, how much it is actually worth. This is what the overreaction effect means. Number 4 over here is your small capitalization discount. Let us understand what this means. Now, basically, when you are in a market, the people who are institutional investors who manage, huge amounts of money, these people really, influence the value of a company. If any big fund has invested in a specific company, then the price tends to go up because, the general retail investors also think that if a fund is investing in this company, then this company really would be, having potential. That's why the fund is putting their money into this company. So what happens is, if when you talk about fund managers, if there are companies which have a small market capitalization, maybe lesser than a few $1 million, so probably the fund managers are not going to have such companies on their radar, and these small companies remain a remain being valued as smaller companies, because no big fund is investing. And if no big fund is investing, then probably the people do not get to know that, okay, this fund has invested, so we should also invest. So hence, this basically means that the smaller companies tend to remain smaller in their value. Now let's also talk about the fifth factor. This was the fourth factor, market imperfections and anomalies. Let's talk about the fifth factor, which also influences practical business valuations. This is about behavioral finance. Now, this is again a very interesting topic. There are a few terminologies that we will study over here. And personally, these are a few terminologies which I find very interesting. So let's get started with this. Number one over here is herding. Now, what do you think herding could mean? Herd means a flock of sheep which are, moving together. So what happens in herding? As the name suggests, the fund managers basically tend to follow each other's strategy. So if one fund has invested, other fund will also invest. This is how people follow each other's strategy. So this leads to stock market bubbles. This is another reason why, if a share price is increasing, more and more people will invest in it and will continue to increase, but the value is not so much. So ultimately it plunges down. Then let's talk about another factor. This is called noise trading. What do you mean by noise trading? These are basically traders who do not base their decisions on any rational analysis. They simply follow the trends and overreact to good or bad news. So if if there's a very good news, I will just buy that share recklessly without even analyzing whether the company is good or not. Fundamentally, I'll just go on the basis of news and react recklessly to the news. Similarly, if any bad news is there, I will not look at the other things. I will just, on the basis of the bad news, I will start to sell that share. So this is what noise trading is. Number three, when it comes to behavioral finance, is loss aversion. As the name suggests, I'm trying to run away from losses. So what happens is, usually the investors tend to prefer to invest in those companies which are earning steady profits. Even if they are low profits, they will prefer to invest in companies which are steadily giving them profits, rather than investing in any company which makes high profits in some years but losses in the other years. So because the investors want to stay away from the losses, they will prefer to invest in companies which are steadily earning profits, even if they are low profits. Then the fourth point that we discuss under behavioral finance is going to be your momentum effect. Momentum effect basically means, let's suppose the market is having an uptrend, it is continuously going up. So what happens is, markets will create an optimism. Optimism means a positive sentiment, which will increase the willingness of the investors to invest in companies which are showing the prospects of growth. So if, let's suppose, the shares of one company are constantly growing and growing, and the people become more optimistic that, okay, this company has prospects of growth, and so they keep putting in money in that company. This is what momentum effect is. Then number 5 over here is your confirmation bias. Confirmation bias essentially means, let's suppose I have made an investment in a company, and confirmation bias basically will only allow me to focus. It will only allow me to read or hear about any news which is positive about the investment. So let's suppose I have bought the shares, so I want the share price to go up. So I will constantly look for news which will confirm that yes, the share price will go up. I will deliberately ignore any such news which goes against my analysis. This is what confirmation bias is. All of the points that we are studying over here are termed under behavioral finance. So this basically talks about how human beings behave, and how the behavior of the human beings causes imperfections in the market. So let's move to another point. This is called as illusion of control. Now, what do you mean by illusion of control is that, there are a few investors who believe that they have a significant control, or, whatever they do it's going to affect the market. So this is, something which a lot of people do believe that, okay, I have bought this share, now a lot of other people are going to buy this share, and because I have bought it, other people will also buy it. So there's an illusion that they have, that they believe that their actions will have a direct effect on the stock market. If they have bought something, it's got to go up. If they have sold something, it's got to go down. This is what illusion of control means. Then, talking about the last point when it comes to behavioral finance, is that overconfidence or excessive confidence. Now, what will happen under this scenario is that the investor over here has a tendency to hold a false or a misleading assessment of his own skills, expertise, intellect, or abilities. So they are going to believe basically that they are better and more able than they actually are. So whatever I have done, basically an investor who has this sort of a tendency will think that, okay, I have done this, so I am definitely correct. I have done this, I cannot go wrong. This is what overconfidence and excessive confidence is about. These are the few areas regarding behavioral finance which also affect the valuation of a business when it comes to practical real life. So with this, we have come to an end to this chapter. In the next video, we are going to revise ratio analysis. Like I'm telling you, it's going to be a very short video. I hope that this has been useful, and thank you for watching.